Good day, folks. This is Chris checking in for TradeTaxPlus Center of Excellence. This is our second video for October, the technical video, and this will deal with corporate social responsibility programs. Now, there's not much to be said about this topic which hasn't already been said. The challenge has always been to how closely is this activity linked to the making of taxable supplies. Now, what we have seen creeping into the vocabulary of VAT, and we've seen this in the De Beers case, we've also seen that in infamous 711, ITC 711 case, where two things came in there. The one was in the De Beers case, a necessary concomitant. Is this thing I'm doing a necessary concomitant of doing business? And I think, and I should go back one step, I'm interrupting myself, but remember that comes from the old case of Port Elizabeth Tramway, an income tax case, where they had to decide whether certain things that happened there was a necessary concomitant of doing business, and in that case the court held it was. But the test still is this a natural outcome, a necessary concomitant? And that's not of doing business, that's now crept into VAT, and it should be, because I think it's the right way of thinking about it. So is a corporate social responsibility program a necessary concomitant of doing business? I think there's a very strong argument that it is, that you have no choice, that if you want to do business, that is what you're going to do. And I think that link is close enough. But the next test then is it out of, and this is the concept of pure gratuitousness, and that's come out of the VAT case 711. If something is out of pure gratuitousness, the motive is pure gratuitousness in terms of doing something. They also use the term disconnected benevolence or something like that, disinterested benevolence. So I'm not interested really in what the outcome is. I'll just give away the stuff and hope the seed lands up somewhere. But I don't get any benefit out of this. If that is the case, then it can't be a taxable supply. Then it's simply having given something away. Highly unlikely that would be the case in the case of a formal social responsibility program, where those things are formalized and a specific process is followed, and of course tracked and reported upon. This is see what we're doing for the community. So, in short, the basic principle is if something would have been deductible for income tax purposes, it's most likely also deductible for VAT purposes, because it's the necessary concomitant, it's close enough linked to that supply. Would it be a disinterested ambivalence, a terrible word, out of a motive of pure gratuitousness? Highly unlikely in a VAT environment or in a business environment, where you always aim at a business increasing the value of the shares of the shareholder. That is what you do. Shareholder value is what needs to be increased. So you can't just start giving stuff away. It doesn't work like that. Definitely not in listed entities. In private companies, there might be some element of that, where the person, the sole shareholder, just wants to give something away and they simply give it away. Possibly, but at the level of institutions, of public companies, highly unlikely that will ever be the case. So there's some thoughts to make you think. You're welcome to share your own views on that. But also, again, share these videos with other people if you think they might be interested in what the views are, might impact it, or maybe they're simply interested from a self-development perspective. Okay, so enjoy the videos from me, Chris. For now, checking out for TradeTaxPlus Center of Excellence.